We have changed. We have a new presentation now coming up. We have two experts from Oracle, and I wish, of course, to have also the presentation. Yes, Oracle, one of the most famous data processing companies in the world, and I, of course, welcome now Mark Rakhmilevich. Thank you. And Lorenzo Cremona. Lorenzo is also coming, or he's coming, yes? Where is Lorenzo? Hi, hi, Lorenzo. And you will talk about conservative approaches of distributing digital instruments, you call it, to the public. And you have both background in computer science or cryptography, Mark. I heard about that. And yes, tell us what Oracle has to say, and we're really excited. Also, this is the innovation desk. So we put this, if you show us how your approach progresses beyond state of the art, that would be cool. Thank you.
Oh, absolutely. Hello, everybody. So I'm Mark Rakhmilevich, and I have Lorenzo Cremona with me. We have been involved in some of the space for about 6 to 8 years. We have started with an enterprise blockchain solution, a DLT, based on Hyperledger technologies from the Linux Foundation, first about 2018. And have then been working on a variety of use cases across many industries, many verticals. In more recent years, the last 3 to 4 years, we started getting involved with digital assets or digital instruments, particularly for financial services, banks, asset managers, and so on. So we are going to talk a little bit about some of the latest challenges that are happening that we see in our discussions with those financial institutions, and some thoughts on how to overcome that, particularly in the context of public chains. We'll start a little bit with an enterprise approach and what we think is going to be a suitable mechanism for more conservative banks, starting with permission ledgers, but then moving on to public chains, particularly for the distribution of stablecoins and other instruments. So let me pass it on to Lorenzo, who's going to kick this off. Let me just see if we can. Yeah, this works.
Good morning, everybody. Can you guys hear me? Yeah, okay, great. Okay, so as we sort of describe what digital assets are, we've kind of broken it down into 5 primary categories. And they all kind of have their nuances in terms of the way that they're actually managed and ultimately the way they're regulated, right? So if we talk about tokenized security, it's a regulated entity. We talk about the complete opposite, cryptocurrencies are totally unregulated. And then obviously, you know, we talk about stablecoins, which seems to be a hot topic as of late, although I think the conversation is moving back towards tokenized securities or tokenized deposits, because I think it's probably easier for banks to eventually offer that service initially, as opposed to stablecoins, as we sort of try to understand exactly where the regulations are going, right? Then we talk about central bank currencies, digital currencies, which ultimately the EU is in the process right now of hopefully finalizing and getting at least some of that underway, especially as it relates on the retail side and not necessarily on the wholesale side, which we're already sort of in the, you know, headed in the right direction. So the interesting things about the assets themselves is that, you know, it's how the actual assets are being backed, whether they're backed by fiat, which is traditional currencies, whether they're backed by some type of a tangible asset, if you will, or they're totally arbitrary, right? So you've got this kind of microcosm of many potential services and offerings that banks and traditional banks can offer, and ultimately we need to figure out exactly how technology is going to eventually accommodate the this let's call it this ecosystem. So as we're all familiar with digital assets and ultimately what the benefits are, one of the primary benefits is obviously the fact that it never sleeps. It's 24/7. You've got immediate reconciliation. You've got immediate asset valuations against liquidity or some kind of a tangible asset. The technology itself, if you will, as it relates to digital assets, allows you to basically do atomic transfers, which at the end of the day are what core banking systems are all about when it relates to actually fiat type of assets. You can increase kind of your investment strategy, if you will, around digital assets. It just makes life a lot easier, a lot simpler, especially as it relates to things that have to do with cross-border payments. The automation of manual, error-prone, potential errors is eliminated, predominantly because everybody's kind of, how shall I say, singing off the same sheet of music, so to speak, allowing you to ensure that your data or your actual transaction, if you will, is consistent with all the parties involved, including the regulators themselves. You've got real-time continuous, what we call asset valuation, which the idea is that it's constantly sort of being reevaluated based on certain type of market dynamics. You don't have to worry about static sort of valuation, which ultimately can, in the course of time, have significant impact on your actual asset as it actually goes through its quote-unquote life cycle. And obviously reduced cost and time, not only in terms of the actual asset itself, but how you introduce, eventually new services and new products into the market. One big point is if you look at financial assets, the market capitalization is enormous. And with digital assets being part of the market cap of financial assets, this creates or presents an incredible opportunity for banks to diversify themselves and ultimately be able to offer new services and products. The evolving landscape of money, it's very, very simple. I think Marx is going to get a little bit more into some of the specific technical details. But if you look at the way that money is actually fragmenting itself with the introduction of digital assets, you look at, four major categories. You've got your classic fiat deposits, which are based on existing currency valuations. You've got your tokenized deposits, which we'll get into a little bit. You've got the stablecoins, which again, we'll specifically talk about sort of the bridge between the two. And then obviously the central bank digital currencies, again, as it relates to the retail side, because I think there's still a lot of questions coming up in terms of the way that's actually going to be handled, especially in the EU. In terms of the challenges, so one of the biggest challenges right now is that I think everybody's experimenting with the technologies with regard to both tokenized deposits as well as stablecoins. But now we have to kind of sort of make the shift between pilots, proof of concepts, ultimately, and moving the stuff into production, right? And some of the biggest issues come up around regulation. Ultimately, as regulation is being introduced to actually manage these particular digital assets, if you will, we have to ensure the technology sort of is compliant with the regulation. So in the case of some of the early experiments in the United States, especially with some pretty well-known players, banks that have decided to invest in this type of technology, the risk is huge. I don't know how many times JP Morgan has been fined for not following regulation as they evolved into sort of digital assets, but everybody's trying to avoid that. So you have to sort of accommodate regulation as you introduce the technology to then offer these new services and these new products. And then the opportunity is huge because you're able to effectively deliver faster, smarter, if you will, more dynamic financial products to your customer base. And then you can extend the liquidity, the value of your asset into a digital form. Is this clear to everybody? Okay. So here's where sort of we are going to offer a little bit of insight in terms of the way that we and our customers, by the way, Oracle's been obviously in the financial services business for a very long time, considering the fact that we're a pretty well-known database company, or at least data management company. We also know a lot about transactions. We know a lot about transaction management per se. And I would say that if you look at some of our middleware technologies that ultimately manage obviously the data and the transactions, we probably satisfy over 80% of the world's financial institutions, not only from the database perspective, but also from the financial management perspective. We also have ERP systems that ultimately have to interact or have to integrate with payment systems. So this is kind of a natural evolution for Oracle to move into the space. And we, as Mark had mentioned, we've been in the space for approximately 8 years. Around DLTs, if you will. And our DLT solution has evolved from a classic sort of blockchain implementation into the financial realm. And we are actively involved in many projects, if you will, that are, that eventually will help us collectively solve the big problem that we're going to be addressing today. So if we talk about the tokenized deposits, so this is, at the end of the day, it's just taking the banks, call it their existing liability, and convert it into some kind of a digital form, right? We talk about stablecoins. This is basically creating an instrument that is backed by some kind of collateral, if you will. So the interesting thing is ultimately is, how do you actually create a product and then take it to a market, considering the fact that you have to maintain both a private as well as a public blockchain environment? Does that sort of resonate for folks? So how do I create an actual token, if you will? I'll use a loose term, and then ultimately introduce it in a way like an Ethereum-based system, which is a permissionless blockchain environment, and then keep the two sort of representations consistent. Because we think that that's where the market ultimately is going to have to evolve to from an infrastructure perspective, being able to satisfy or support that kind of a transaction.
Lorenzo,
Yeah.
We stream that. It would be important. It's not for the auditorium that you use also the microphone a bit. It's turned on, so you could just
Okay.
you can
Oh,
use
okay.
it.
Just
But it's for the
close it.
streaming. You want also to spread the message online, I hope. So that would help.
Okay,
Also,
sorry.
that our technician support, they would love that. You're welcome.
Okay, thank you.
Thank you, Lorenzo.
So the strategic approach to this, quote, dual rail challenge is what we're introducing right now is, the idea is, you start with a tokenized deposit on a permissioned environment. In other words, what do we mean by permissioned blockchain environment? You guys familiar with that? Anyone familiar with Hyperledger Fabric? Okay, so yeah, that's a permissions-based environment. So you need to be invited to participate in the blockchain, in the actual network. The reason why we believe that that's a good place to start is because obviously there's going to be legislation or there's going to be regulations that are going to be applied to this. And regulations means that you actually have to have external authorities ensure that you're compliant with some of the standards, like MiCA standards, obviously, in Europe. The important thing is the creation of the actual digital asset in a permissions-based environment gives you the absolute security that the actual asset itself is at a regulatory level compliant. The benefits for the wholesale banking is obviously, you talk about wholesale settlements, the fact that you've got, 24/7 liquidity. You don't have to worry about batch processes at night. You don't have to worry about, ensuring that the actual value of the asset changes, is updated regularly. Treasury automation and some of the actual strategic defense in ensuring that your actual deposit business is basically backed, by emerging movements in the actual market itself. And then we have the worry about preparing for the stablecoin avalanche, is what we refer to it as. So the idea that, large financial institution can kind of mint their own sort of instrument backed by some kind of a collateral, obviously. We believe that most banks are not in the business of creating these types of environments. So they're going to have to partner with specific technologies that allow them to actually execute on whatever objectives that they have around their stablecoin creation and adoption. And this is where the infrastructure play becomes very, very important for us, rather for everybody. So if you look at some of the challenges that we have today, the biggest challenge is the fact that there's a lot of isolated sort of systems, independent systems that ultimately have to talk to each other. So one approach is to integrate all those systems, but the integration will require some kind of standards being set and standards being adopted. And then ultimately, what could potentially happen is as you introduce various disparate systems, you have to also worry about the actual systems themselves, whether from a technology provider perspective, they're going to be around in 5 or 10 years. there's going to be certainly some kind of market consolidation as some of these systems actually come up and running. There's going to be some adoption. There's going to be obviously evolution. Again, the important thing is the underlying infrastructure that supports the integration, if you will, of all these various systems, what we typically refer to as distributed ledger problem. So one of the ways that we're actively working on some solutions, if you will, or some actual experimentations, including the CBMT project. Are you guys familiar with CBMT here in Germany? Okay. Universal Bank Money Token. Anyways, I was actually here a few months ago during the CBMT kickoff, in which we introduced this call it pilot. And Mark will probably get a little bit more specific into some of the technical nuances, but the idea is that you sort of banks themselves independent of whatever solution that they introduce as part of their stablecoin strategy. Those stablecoins ultimately are exchangeable between the actual banks themselves. And the way that we solve this, or the way that the problem is solved, is by creating some standards across the interoperability between the systems, which becomes very, very important, because if this project is deemed successful, and when we talk about this project, it's not just a proof of concept, it's an actual pilot. So the idea eventually, when this project gets fully accepted and ultimately rolls out, the system is already up and running. And we're providing a layer of that particular technology, which hopefully you'll probably speak a little bit about. Yeah. And then obviously the idea is to set it up so that this is going to be something that's going to be from an adoption perspective, globally expandable. In other words, creating certain standards that allow basically for the adoption of these disparate systems will allow us to basically do cross-border payments in a much more efficient way as these standards obviously come up and running. So the long game basically is what we call the dual rail model. So you've got the permissioned rails, which is obviously the hyperledger, if you will, sort of world, and then you've got the public rails, which are the Ethereum type of worlds. Those have to be interconnected. They have to be almost seamless between the two for this thing to actually work properly. So the ultimate goal or the ultimate objective is to create new revenue stream for banks, financial service institutions. Being able to effectively do liquid transformation, programs, payments, and settlements, and then look at it as compliance as a service, obviously, because regulatory compliance is going to be key in being able to pull this off. And it's not just on the banks to be compliant, but it's also on the technology companies to be able to effectively put up a system that will run compliance ubiquitous. So I'll turn it over to Mark.
Great, thanks, Lorenzo. All right, so just I'll add a couple data points to what Lorenzo mentioned earlier in terms of Oracle's experience in financial services in particular, and a lot of this comes from having worked with a large number of institutions over the last few decades. For example, I think it's 24, 25 of about 30 globally significant financial institutions, CIFIs, running Oracle technology in various forms. And we have a deep understanding of the current payments implementations and the requirements that make them as successful as they are today, with various limitations and batch windows and, so on in various payment systems. More recently, faster payment systems that support more real-time capabilities, InstaPay and all of that. But nevertheless, so a lot of this comes from that kind of background. We believe that for many banks, starting with tokenized deposits on permissioned rails is going to be a simpler place to start. It's a more forgiving place than public chains where you don't have any legal recourse if something goes wrong. In a permissioned environment, you have organizations that agree to work together. At the end of the day, they can always, if not through technical means, then through legal means, address whatever problems might come up. You don't have that luxury in a public chain environment. But to start with permissioned rails, in tokenized deposit world, you're going to need to have, obviously, the core ledger infrastructure, Hyperledger Fabric, Hyperledger Besu, various things of that sort. You're going to need strong segregation in role-based entitlements. In many institutions, they don't necessarily want to have administrators that can manage users, manage systems, manage financial transactions, all in the same role, in the same person. So deep segregation, very granular role-based controls, separation of duties, and policy around governance is one of the very important factors. The implementation of the smart contract controls, things like limits, permissioning, allow listing, ability to suspend and resume accounts, freeze and unfreeze tokens, and also manage not just the tokens, but manage the smart contracts themselves from an update process, right? That software that inevitably has to get updated. You need strong governance around that as well, and approvals that will satisfy the auditors that the governance is in place. A very important factor as well is integration with existing banking systems, the core banking, the KYC, AML, sanction screening, and the like, because without that, you cannot run a regulated financial product or service. But that integration is not easy because you have a lot of differences in the way that things happen on a blockchain rails in near real time, and some of the internal systems that are more file-based from an integration perspective that respond to particular type of events. So implementing sort of this layer of integration in between the blockchain and existing off-chain systems is an area where we see significant challenges that some of the banks, some of the leading banks that have been investing billions of dollars in implementing their own digital asset platforms, this is where they face the most challenges in the integration areas. You also need to be able to then start integrating across multiple ledgers as well. If you're going to be running your tokenized deposit and you want to be able to participate in a multi-bank consortium with a tokenized deposit being exchangeable, you're going to then have to deal with cross-ledger integrations as well. And then, of course, things like real-time monitoring, liquidity dashboards, integrated supervision, particularly where you can do things in a pre-transaction mode to determine the approval levels, execute through the smart contract with appropriate controls as well, and then post-transaction also apply supervision, reporting, detecting financial crime, market abuse, and those kind of things, and turning those particular discoveries into some actions, again, back through the smart contracts as a closed loop. This is a kind of capabilities that are pretty mature today, actually, and available, certainly from multiple vendors, not just Oracle, but and we find that working with some banks in implementing this builds additional confidence, allows them to learn how to deal with tokenized money in a controlled environment, how to handle the integration requirements, and what it's going to take to successfully integrate with a variety of internal systems, and then how to do sort of the supervision in all of these different phases, pre-transaction, during transaction, post-transaction. Now, the next phase, when and if stablecoins become available from a regulatory perspective, approvable, etc. Certainly in the US, the Genius Act is already moving in that direction. And there is a lot of companies, a lot of banks and non-bank companies that are moving rapidly to be able to comply with the Genius Act requirements and then be able to offer stablecoins in the next 12, 18 months. We're seeing now in some other countries, across Europe, certainly Canada, Singapore, Hong Kong, the emergence of push to offer their local stablecoins denominated in their currencies as well. And it's going to be interesting to see how those regimes differ from the US regulations or how they're similar in that regard, right? And where some of the gaps are going to be. Because one of the things we know people love to take advantage of is regulatory arbitrage. And so to the extent there may be differences in the regulations, we're going to see that. But one of the bigger challenges that we see as well is that for stablecoins to be successful, you want to provide public chain distribution. You want to be able to distribute them in an environment where there is the largest liquidity across certainly public chains, and more than one, typically multiple public chains. You look at USDC today, for example, some of the other tokens, they're available on multiple chains. When you're dealing with public chains, you have then this very adversarial environment that's not really subject to any legal restrictions, certainly not internationally. And so that's driving a lot of additional platform requirements, operating requirements, and so on. For example, on infrastructure side, if you're participating in a public network, you need to have a hardened, high availability environment for your nodes, geographic resiliency and distribution, redundancy, disaster recovery, those kind of capabilities. Key custody, key management becomes much more important. Again, there is no legal recourse if something goes wrong, so you have to make sure that the keys are protected, typically through sharding, MPC, or using HSM devices as well. There is a significant debate out there whether you should allow to have users manage their own keys on their own devices. for banks, that becomes a distribution and support challenge. Imagine, 10 million, 20 million customers in a large-sized bank and devices, and you have to be able to handle key distribution, key management, recovery, and all of that when something happens. So there is sort of a thought that really users should not be managing their own keys. They should be custodial wallets, and then there should be an authentication mechanism and attestation associated with that when it comes to access to that custodial service. There is a set of concerns in public chains around market integrity as well, safeguards. So validators have gotten smart about how to do basically a front-running kind of operation before particular tokens going to be issued or transacted. They can try to maximize what's called extractable value, MEV, and so there are some dynamics happening that you really would like to protect against. If you're issuing on multiple chains, transacting on multiple chains, cross-chain risk controls and liquidity, it becomes important because ultimately those stablecoin instruments are going to be tracked against your reserves. You have to be mapped one-to-one, and so you have to manage that on a real-time basis. You have to detect money laundering and sanction events and things like that on a real-time basis as well. And if you're transferring across multiple chains, then atomic transfers are very important. You don't really want to leverage existing sort of bridging technology because that's very vulnerable. So at some point, your asset moves from one chain to another chain, but in between, even if it's for a very short time, it exists somewhere outside of the blockchain world. That's dangerous, that's risky, and we hear constantly about the breaches happening in those kind of things. We believe that you really should focus on the kind of capabilities that allow for chain-to-chain transfer that's atomic. So the asset either exists on one chain or the other. If it's transferred successfully, then it lives on the second chain, on the target chain. If it hasn't, then it remains in the wallet on the original chain. And I think that's one of the key requirements. Now, that's a lot of difficult technical problems that need to be solved. And we think that there are some ways of mitigating that through what we call conservative stablecoin issuance approach, which is essentially based on a hybrid model. As Lorenzo alluded earlier, you can mitigate some of the risk by actually issuing stablecoins on a permissioned ledger, which would be a system of record for auditing, for legal, and then distribute a wrapped version on public chain, which is basically you're distributing a token representation on a public chain. The benefits, of course, doing your controlled mint and burn processes on the permission ledger side, so that's much safer. You don't have unknown validators. You reduces that exposure, but then you're actually preserving optionality. If you start with that, you have a compliant instrument on the permission chain, and now you can add the public distribution option at the right time, depending on regulatory requirements, depending on what you see, where the market's moving and so on. So the way this works is you do an initial mint operation in a private regulated environment using your permission ledger. You can then lock that token or that amount in a vault and reissue basically mint wrapped version representation on a public chain through, again, a smart contract that provides things like supervisory control, jurisdictional limits, ability to freeze distribution, ability to claw back if necessary, and so on. And so as tokens get exchanged, you have some degree of control there, and then you have ability to redeem, of course, when the token needs to get redeemed by redeeming it on a public chain at the same time as you unlock it on a permission chain, where you can then burn it, and you have ability to then settle the changes to your reserve balances based on that event happening on the permission chain. We know there are some banks that have been trying for a while to implement those capabilities. Generally, it takes a long time, significantly high development costs in billions of dollars. So some of the bigger banks can afford to do that, but very few. Most other banks actually looking to either partner with somebody who already has the capabilities, or put in basically a vendor-supported capability to do that. There's a significant risk, particularly around confidentiality in public chains. You don't want to disclose any private information, but at the same time, in order to comply with travel rule requirements, for example, and AML requirements and so on, somehow when you're transferring, if Lorenzo and I bank at different banks and I have a stable coin that I want to transfer to him, his bank has to ensure that before they put it into his account, it complies with all of the regulatory needs and requirements in their jurisdiction. And so they need to know who it came from, right? It's not enough that you say it came from this pseudo-anonymous wallet address. So you have to provide this additional information in a way that allows them to verify, sanctions checks and AML and KYC requirements and all of that. So there is a lot of work being done to sort out how to implement that without obviously putting PII information, on a shared blockchain environment, or at least not in a, accessible way, right? And we're working with some interesting technologies in that space. So our perspective is that institutions that are going to be successful are going to deploy infrastructure that allows them to evolve from permissioned rails to integration with public rails over time. It's not going to be two separate environments or two separate systems because the gaps are going to be too hard to deal with. That's where security issues will happen, operational issues will happen, and so on. So you need a unified platform to do that. There needs to be strong compliance and supervision capabilities in that space. Pre-transaction, as I mentioned, sort of off-chain workflow orchestration for KYC and sanction screening, on-chain through smart contract, and then post-transactions through risk scoring, verification of linked documents. Imagine that if you're doing a B2B payment, maybe in the supply chain context or some supplier, you want that payment to be linked to whatever history of invoices or purchase orders, and that provides basically attestation that this was a legitimate payment. So all of those things are kind of important. And then, of course, if you're going to deal in the hybrid environment between permissioned and public chains, you need atomic interoperability, and you need to address those requirements for cross-chain interoperability overall, but specifically through things like two-phase commit, and in other approaches. For example, there is a new emerging protocol in IETF called Secure Asset Exchange Protocol or Asset Transfer Protocol, SATP. And it's recently has gotten strong support in ISA community. So we participate in ISA 307, Technical Committee 307, and there is a working group, a subgroup, I think it's working group 8, that focuses on interoperability, and they have finalized the approach to this secure asset transfer protocol. The next steps, we think, are going to be turning it into an RFC. So just like, in the early days of internet, people had to deal with a lot of incompatibilities until some of the RFCs got implemented. So, when you send an email today to somebody else, you don't really worry about what email systems are running or what standard it's using. It's obviously going to be interoperable. And so the same thing is going to happen, I think, with digital assets. Yes, you have a question? Well, there's been, I'm not going to name any specific ones, but I think if you just scan the headlines in the last 12 months, there's been a number of situations where cross-chain bridges have been hacked and, money's been lost. So again, I'm not going to go into specific names, but you're going to, see if you look for, bridge hacks, bridge attacks, etc., money leaking, etc. There's been those kind of, situations over the last year, 2 years probably. Folks like Chainlink, for example, they do a better job of ensuring that funds always going to exist on one chain or another chain, so they handle the protocols in a way that are more atomic. But not everybody does that. The other issue, by the way, that comes up is what we call finality mismatch. In a permission chain, you have deterministic finality. In the public chains, it's probabilistic finality, and so you have to ensure that you deal with that gap, if you will, when you do the lock and mint operation. You need to do that atomically. When you're doing redeem and burn operation, redeem and unlock, that needs to be done atomically as well. And so the differences in finality have to be handled. And there's various approaches, again, to that. It really depends how much latency you want to tolerate, or, if you want it to be real time, near real times, and there are some other approaches as well. So we have an implementation of an atomic cross-chain transaction using two-phase commit with some optimizations. You have on the right-hand side an Oracle blockchain platform with a tokenization stack on top. On the left-hand side, you have an EVM-based tokenization environment. This could actually be any EVM-compatible blockchain for that matter. And in our environment on the right-hand side, we have an Ethereum client implemented that lives under 2PC conditions or two-phase commit, using what we call LRC extension. This support atomic asset exchanges, where you can essentially do a first phase of the two-phase, which is a prepare phase, on Oracle permission chain. You can then go run the transaction on the EVM side, determine that it's been committed based on certain rules, a number of blocks, time, and other things, the finality settings. And then on the right-hand side, on the Oracle side, you can go ahead and commit it. And if on the left-hand side something fails, then you can do a rollback. So these kinds of capabilities, I think, are going to make it simpler to achieve this kind of atomic, cross-chain interoperability, and that can support atomic asset exchange for things like delivery versus payment, ROP tokens, again, lock and mint kind of operations. You can also generate, for example, an event that can trigger, maybe there is some kind of a supply chain transaction happening on a permission chain, and then it triggers a payment on Ethereum, again, atomically. Or you have a private transaction that is anchored by having some kind of representation through a hash or maybe a ZK rollup on a public chain as well. So some of the capabilities that use cases that this supports. This emerging secure asset transfer protocol, which I alluded to earlier, is actually going to be stronger by providing the gateway capabilities. So you have essentially on the left-hand side diagram, you have the SATP bridges between the two networks, and the right-hand side diagram just expands it a little bit and shows some of the stages of that protocol. There's certain requirements around the SATP bridges, working with different DLTs and DLT networks. So there are currently available implementations for some of the more popular networks and more coming. Those operations have to be mathematically verified to be correct. Obviously, from a protocol perspective, they must be atomic, and they must be auditable. You want to ensure that from a governance perspective as well, you can show and demonstrate that everything that happened is properly tracked and visible, and you can prove that what you intended to happen did actually happen. There's a paper, there is a link there. The presentation will be available, I think, shared on the website. So there is this link to this paper on implementing secure bridges, learning from secure asset transfer protocol, and we've been working with it with some of our partners like Quant Networks. So overall, we think that this unified digital infrastructure is what's going to allow banks to be successful. You are going to be able to move to production scale operations with all of the compliance requirements, stringent operational requirements, and our individual, siloed capabilities get linked together. And then the institution itself plays a role of system integrator having to deal with all of that. Unified governance platform is going to provide more safety. It's going to be easier for regulators ultimately to approve, right? So it will provide the auditing, the controls, observability, all of the standardization in terms of workflows and integration with existing core banking systems and various internal systems. We think ourselves as essentially providing enterprise hardening on top of the open stack software. So a lot of it based on open source and open standards, but with an institutional wrapper that makes it work together in a more controlled manner with transparent control design. A lot of innovation driven by many customer engagements. We have been involved in some really interesting CBDC, central bank digital currency projects last few years around the world, and there are some very, very precise and strong requirements that we've learned from that we now adopted into the next generation of the system in terms of implementation of limits, implementation of what's called make a check approaches, where every significant transaction actually requires double approval, or what's called 4 eyes, and many other things of that sort, right? The limits, daily transfers, limits and holdings, ability to enforce limits based on the type of account. So you might have an account that's individual or maybe corporate. It may be a small company, large enterprise, local, international. There's all kinds of considerations that go in that depending on who holds the account. So we have a bit of a demo here that we've prepared actually to show you where we are able to run essentially this hybrid environment across 2 ledgers. This is a demo of a certificate of deposit issuance. We're actually working in South America with some banks on this. They want to be able to use blockchain to issue certificate of deposits on the permission chain. That goes through a lot of pre-approvals, obviously documentary processes that are captured there. Ultimately, it's issued as an NFT token. And then it's actually transacted and wrapped as an NFT on Ethereum. We're using Hyperledger Beso as a stand-in for an EVM Ethereum network in atomic manner. So I don't know if I have
Yeah, you have a video.
Can't, but
you get some.
What I wanted to point
Yes.
out was, at the bottom here, this is where we have the Ethereum portion. The rest is happening on the permission chain. But yeah, we have a video here, so let's see if we can. I'm going to need to step through it. All right, so we're going to skip some. So in the setup, I just wanted to mention what we're going to do in the first few steps, right? So we have this financial institution where there is a customer that's going to, request basically a certificate of deposit. There's going to be an approval process. They do credit checks, they do various other things, and then they actually create that. In the process, they verify KYC information about the customer, credit ratings, etc. And that's step 2 and 3. And then step 4 is where they actually issue that on chain, and then the customer can purchase it through some fiat transfer, so basically from the DDA account. At that point, in their wallet, step 6, they're going to have the NFT representing that certificate of deposit. Then we can wrap it and put it on the permission chain, or keep it locally. So sometimes they are going to just want to keep it for full duration of the maturity. Let's say it's a 12-month certificate. But there are situations where they purchase a 12-month certificate, but then they decide month 7, month 8, they really need the money. They don't want to wait 12 months. So they want to put it on the secondary market for trading, and this is where the public chain comes in as a secondary market, so that they can sell it for whatever remaining value of the remaining 4 months is, for example, right? So those are the two options. Here's a sort of architectures that we have. So you have multiple financial institutions on the blockchain. On the right-hand side, we have the permission blockchain. On the left-hand side, we have Besu standing in for public chain. On top, we have an identity management system. We have a workflow implementation that orchestrates between the two chains through the API gateway. We also have a database, so we replicate a lot of our ledger transaction data into database for monitoring live real-time supervision, and then some analytics obviously generated from that. And then, on the right, there are other financial institutions that also have their own blockchain nodes, API gateways, and so on, right? As part of this essentially network that is a consortium network. Okay, let's see. So here we're going to go ahead and we're going to log in to the system. We have some active certificates. This is administrator logging in as a corporate officer. And there's going to be a request entered through some e-banking channels. So Bank of Utopia, we call it, as an issuer. The amount that we're entering, the company that's requesting the certificate, right? This is for corporate treasury purposes. This is now created with particular details of the amount. So this is actually registered on the permission blockchain. You see there is approvals that's pending. So we've done the first few steps. All right, now we have the approval flows. And again, you want all of those approvals for governance and auditing reasons to be captured on the blockchain as well. So we're approving that. We're specifying some dates around issuance and maturity. Assigning interest rate. Again, we're doing it in the UI, but typically this would be done, of course, in an automated system through the backend API, just in order to show it as a demo. We have built a UI to show some of the processes that are happening. All right, so we've gone through the approval process. Let me advance it a little bit here. All right, here we go. Here's a dashboard. So the request has been completed, and now final approvals. There is documentation. Again, all of the documents are captured through cryptographic hashes on chain as well, so they can be verified against any potential tampering or deletion. So the actual certificate document, the actual legal document has been now approved. There is some KYC verification that's happening. And it's just an API through blockchain oracles, basically a call out to some existing bank KYC systems. All right. So now we actually can go ahead and issue the actual token itself. This is going to be ERC-1155 based NFT token. And you see there is a number that already been issued, and verified means that we have actually checked the hash on it relative to the actual document itself. So that verification has happened, and now we have a token that we are creating based on that process. And so all of that prehistory, if you will, right, that happened, that's all been captured on blockchain, right? It's not just go and issue a token without any prehistory, and you have to prove why it was issued, who it was issued for, and on what basis. All of the history is captured. Right. So now you can make it available for corporate treasurer to be able to view the certificate and actually acquire it. So this is where the payment's going to happen from a fiat account. And we're just simulating that through some database entries for simplicity's sake. So there is a token ID. There is all of this information about the certificate details, and the corporate treasurer can go and purchase it, confirming the amount details. This is again done through the integration with fiat system. And now they're going to log in and check their wallet to see that certificate has been issued in their wallet. So they have some already, for testing purposes, we had some in the wallet already. There is a blockchain history of all of the relevant transactions that have been captured on the blockchain through the analytics backend. Right, and then you see they can either redeem it after a certain amount of time, or they can list it on the secondary marketplace if they want to actually sell it. And this is where the public chain comes in. So first, I think we'll do a local redemption. They've submitted the redemption request at maturity typically. That goes through an approval. And once approved, they'll be able to see the funds back into their fiat account. And again, this could be approved automatically, subject to certain threshold, amount thresholds or things like that.
I have a question for the presentation. That's very impressive. Myself, I come from the blockchain side of the world.
Yeah.
So what you showed us...
Let me just show the final
yes,
step here.
yes,
There's a hybrid
of course.
network in a minute here, and then we can...
We have still some time to
Yeah.
also explain on what is going on exactly.
Right. I just want to show the marketplace, which is kind of the hybrid aspect of this. So we'll go into the wallet. Okay. Some of it is repeating itself, but so that's all of the analytics. Okay. So now you see actually the e-marketplace. This is basically an Ethereum block explorer that shows the token has been minted there. You have the transaction hash and so on to verify it. And and it's locked on the permission side. And that's done atomically as well. And you can see the ledger summary here with all of the history. And This is a redemption history on the public chain as well, right? So we have the workflow as well because there is workflow components orchestrated on both sides, and this workflow helps us to achieve atomicity between the multiple chains. And you can see some of the details of the workflow involved, with different kind of access APIs and transactions and so on. So we'll just move that ahead. Okay, we don't need to see some of the technical details here. But yeah, so let me pause this. Right, so this is what you've seen in the demo. Basically, you have the two chains. You have public and permissioned. You have the workflow orchestrated between them, orchestrating across the smart contracts, web application and front, just for visibility. All right, so I'll pause here. I mean, there is obviously more technical details, but you'll see that in the attached deck. Let's do some questions.
First of all, thank you very much, Lorenzo and Mark, for your presentation and the demonstration. What I understood, what we understood is that you try to combine blockchain world, the public ledger, and banking systems. That's one of the main objectives.
This is a permission block. So we're trying to combine the permission blockchain environment with a public blockchain environment and with internal banking systems.
Yeah. Do we have any question from our auditorium here? Yes, at the very back. I ran.
Yes.
Yes.
So is that actually then regulatory arbitrage? And if yes, do you think the regulators will prevent that in the future?
No, I don't think that's regulatory arbitrage. I think regulatory arbitrage is when you have different sets of regulations in different jurisdictions. That's what's happening today in terms of use of public chains to a large extent, where you have, depending on the different regimes, if there are some differences in interpretations and so on, then people decide to issue, for example, it's been very popular for some companies to be based in Switzerland because of a particular nature of the regulatory regime, right, that gives them more freedom to issue stablecoins that they perhaps couldn't do in some of the other regions, some of the other jurisdictions. And as you get more approvals, you're going to have the U.S. Genius Act, MiCA in Europe, of course. You have some things happening in Singapore, Hong Kong, and so on. There's going to be minor variations, and people are going to take advantage of those. That's regulatory arbitrage. From a perspective of integrating permission and public chains, that's happening in the same jurisdiction, right? So, you're going to have a bank, pick a country, wherever. They will be under common set of regulations that basically specify what they can do. Typically in a permission chain, right, this is treated as just another form of recording for existing deposits. So CBMT project we talked about earlier, right? Commercial bank money tokens, that's DZ Bank, Commerzbank, I think Deutsche Bank's been involved, and a couple other banks in Germany. They have gotten BaFin approvals to basically treat the deposits as normal cash deposits that they get from their customers. So there is no regulatory difference. The only thing is how technically they happen to manage and record those deposits and how they exchange cash. It's like, if you were to, have a check on DZ Bank and you go to Commerzbank to deposit it, right? They will take the check and they will deposit it for you in your account, right? They have to do some processing to ensure it's valid and all of that. Similarly with a token, it just happens to be done in a much more immediate and blockchain-specific manner, right? Across, multiple implementations of the ledger and what's called CBMT sandbox that provides for the token exchange of multiple color tokens that all map one-to-one to euro.
Any more questions from your side? Anything you want to add, Lorenzo? Or yep.
Yeah, just a quick thing. So when we talk about our Hyperledger implementation of the Oracle blockchain platform, the actual sort of area where we create tokens is something that we've added to Hyperledger, because per se, Hyperledger itself does not have an ability to actually create a token. So we've taken a TTF. I don't know if you guys are familiar with the tokenization token taxonomy framework. We implemented that as part of the sort of what we call app builder, which is our quote unquote IDE or development tooling around the creation of the actual tokens themselves, right? Implementation of that particular TTF coupled with the standards in which the actual tokens are exchanged on our blockchain platform, then ultimately transversed into the permissionless based solution is all based on standards. And these are widely adopted standards. So again, as Mark had mentioned, the fact that we're built on open source technology, we've kind of hardened the open source technology itself to make it obviously compliant, especially as it relates to regulatory requirements, and ultimately be able to create, mint, and obviously burn the tokens themselves, independent of whether you're doing it on a permissions or permissionless-based system. That's the key, I think, to ultimately setting the foundation to be able to then support the integration with the various systems that will come about, including core banking systems. So we've got integration also with the existing ERP as well as core banking systems, because we basically see the actual transactions can take off anywhere at the end of the day, and then ultimately, conclude in both internal as well as external systems. So that's the important thing. I mean, we're trying to promote the idea of having a complete framework to be able to support anything that has to do with digital assets. That's our long-term ambition and goal. Is that clear?
Silence means yes, probably. Thank you. Lorenzo, also from my side, a question: has this system been implemented and is in production in any bank worldwide, or if not, when do you think will come the first real world implementations?
Yeah. So
what's your estimate?
It has been various components of it as it evolved have been in production across a number of banks in Middle East, in Asia. We're working with some banks in South America as well, and so on. And we're continuing to add capabilities. Some of the latest capabilities that I mentioned that are focused on interoperability, particularly some of the SATP standard, for example, implementations, that's coming this summer. We are working with CBMT participating banks as well to provide the core ledger based on Hyperledger Besu and the integration capabilities. And they're in the process of running in this year, basically 2026, 2 pilots. One is being done locally within Germany between multiple corporates, and then another one is being done across Euro and Singapore dollar with a bank that has branches, it's German Italian bank, HB Unicredit, and they have branches in Singapore as well. So they're going to do basically a foreign exchange based on 2 deposit token systems connected together.
This year sounds
this summer.
Near, yeah. It's not so far away. Thank you very much, Mark, Lorenzo, and yes, we have a next speaker coming, but first, yes, of course, applause for this. I'm sorry.
Thank you. We have some sessions coming up in the main hall at 1:50.
Yes. At which time do you have a session in? We will do shameless marketing for your shameless promotion. Yes.
It's, then there is a panel at 2:10.
2:10 and a panel, and also Oracle. Yes. Thank you very much,
Thank you.
Lorenzo and Mark.